welcoming all the viewers through the channel that is Accounting Equation Academy, presenting a class on the topic cost of equity capital under cost of capital chapter, which is very important in the subject financial management. This topic playing significant role in the subject financial management. So far we have understood that how cost of debenture is calculated using the different approach. Similarly, cost of preference share capitals we have calculated in the preceding topic in the preceding video classes, and on the similar way similarly the cost of equity share capital is the today class topic. And all of you know that the equity shareholders are the owners of the company, and in the preceding topics cost of capitals we have calculated cost of debenture, redeemable point of view, perpetual point of view. Similarly, cost of preference share capital, redeemable point of view, perpetual point of view, that is a non-redeemable point of view. But cost of equity share capital is always perpetual point of view, that is it is not a redeemable, only perpetual point of view it is calculated. And the very risky capital of the company, that is share capital, which is comes under equity share. So in other cases like a debentures and a preference share holders, so they know the amount of interest and as well as the amount of dividend, because this interest and the dividend amount is determined or predetermined. And but such a predetermination rate of dividend in case of equity share capital is not available. It is determined by the board of directors at the end of the financial year based on the profit of the business. And generally that shareholders may or may not get the dividend on equity shares. That is why it is a very risky capital. And moreover, on the liquidations of the company, on the winding up of the company, so their equity shareholders have have a very less chance to get their share capital back on liquidations, because the priority given to creditors, debenture holders, and the balance left, if any, to equity preference shareholders. Thereafter, if any amount left surplus, then only the equity shareholders are entitled. So from the dividend point of view and from the liquidations point of view, this share capital is a very risky capital, and shareholders take very greater risks for investing their saving on equity shares capital. And companies always try to maintain the good rate of return to investors, and so that their share prices uh, appreciate in the market. So the appreciation of the value of share and the rate of dividend reasonably, the shareholders are very high expectation, especially the equity shareholders. Okay, so this is the how we cost of equity share capitals we compute. So different authors have developed different approaches, model, method. So commonly used models methods are how we use dividend yield method, dividend yield plus growth in dividend method, earning price method, capital asset pricing method model. So using this model, we compute the cost of equity share capital under different situations by assuming different fact. Okay, so let us start with the first model, a dividend yield method. So this method, under these methods we compute the cost of equity capital, assuming that the amount of dividend is a constant every year. The company is giving the constant amount of dividend to the equity shareholders. All right. So when the every year the amount of dividend is a constant, or rate of dividend is constant, or which is calculated on the face value of shares, then what is the formula is used for calculating cost of equity share capital. So KE stands for cost of equity share capital, and here dividend for equity shareholders divided by net profits multiplied by 100. So this is the net profits. We are getting these terms regularly in the cost of debenture and the topic cost of preference share capital, and even in the cost of equity share capital. So the concept is the same, and if it is the net profit of debenture, so debentures net profit relating, or if it is the net profits of preference shareholders, the net profits of preference shareholders, the way we calculate that is the face value plus premium minus flotation cost or expenses of cost of issue expenses. Okay, and 100. So if the market price is given of equity shares, then we can take the market price also. So formula is same, dividend divided by market price multiplied by 100. So this simple method formula we use under dividend yield method, and this method is suitable when the company is giving a constant amount of dividend to its equity shareholder every year. That is a stable dividend. Here it is given a stable dividend policy over a period of time. Okay, and a company has a stable earning. That means a constant amount of earning company has, and out of that constant amount of earning, the company is able to pay to the equity shareholder dividend is also constant. Very simple. So on this basis of this dividend yield method, I am taking here one illustration. So problem is on your screen. You see here, a company issues 1000 equity shares of rupees 100 each at a premium 10%. So issue of shares at a premium. Here it is the net profits, face value plus premium minus cost of expenses. But the company has been paying 20% dividend to equity shareholder. Has been paying means past many years the company is paying the constant dividend rate. This is a 20%. And for the past 5 years, okay, here 5 years from the past 5 years, the company has been paying this amount of dividend. That is a constant, a stable dividend policy has been followed. So to maintain the same in the future also, compute the cost of equity capital. Will it make any difference if the market price of the equity share is rupees 160? So let us see that we have to calculate on net profit basis as well as market price basis. So the formula which I had discussed with you in the preceding page, here this is the D by NP into 100, that is the dividend on equity shares divided by net profits multiplied by 100 to express in percentage. So the company has issued 1000 equity share. This is the number of shares is 1000, and value of each share is 100. So 1000 into 100, it is 1000 into 100. Yeah, 1000 into 100, it is 1 lakh. So here 1000 into 100, 1 lakh, and the rate of dividend is paying by the company is at 20%. So 20 by 100. So amount of annual dividend is 20,000. Then net profit, so we calculate the face value plus 10% premium minus cost of issue or flotation cost. Okay, so this flotation cost, and the flotation cost is not given, cost of issue is not given, only face value and 10% premium. So face value to 1000 into 100, it is 1 lakh rupees, plus 10% of 1 lakh 10,000, so 1 lakh plus 10,000 is your net proceeds. Okay, this is 1 lakh here. Now dividend D we got 20,000, and the net proceeds we have 1 lakh 10,000, so 20,000 divided by 1 lakh 10,000 multiplied by 100, then so you will get your dividend rate is 18.18%. so here you see this on equity calculations. So this is the dividend is 20,000 and divided by 1 lakh 10,000 multiplied by 100, so here 18.18% is this is, or by reducing the value to the lowest term, then here you cancel the zeros and 200 divided by 11, directly you will get this 18.18%. Now when if it is the market price is given, so then the net profit shall be replaced by market price. So here it is given, if the market price of equity share is rupees 160, so then cost of equity capital is calculated, the amount of dividend remains same, only the market value of shares is 1,60,000 because one share price is 160. So number of share is 1000, so 1000 into 160, so total market value is 1,60,000, and you calculate it, so this is and 12.5%. so here it is your to calculate market price. So 20 directly you can calculate 20,000 divided by 1,60,000 into 100, so 12.5%. This is your 12.5%, so we calculate it. Alright, now this is you by taking the whole amount of dividend, by taking the whole value of shares. Now if you take the one value of shares and one dividend in one shares, then it will be calculated in this manner. So K equal to, if it is the NP, K equal to D. So D 20,000 dividend is given in 1,000 shares. In one share dividend amount is 20 rupees. So that is you calculate here. This is K equal to D by NP into 100. By taking one share price instead of taking 1,000 share price, if you take the one share price, even then you will get the same answer. So dividend here, dividend in this case, so face value is 100, so rate of dividend is given in the question 20%, so rupees 20. So in one share company is giving 20 rupees dividend, so that is the D is 20 rupees by taking one share only, and the value of one share and net profit is 100 and it is issued at premium. So NP equal face value plus premium means 10% premium. So face value is 100 and plus 10% of 100 is rupees 10, so it is 110 rupees 110. So here 110 rupees multiplied by 100, then 20. So dividend amount in one share is 20 rupees. Okay, so dividend amount in one share 20 rupees, and the net profit of one share divided by 110 multiplied by 100, so you will get same value, that is 18.18%. If you take the market value, then K on based on market value. K is based on market value. So here KE D by MP market price into 100. So dividend in one share is remain same 20, and the market price of one share is given in the question 160 multiplied by 100. So you will get 12.5%. So by taking one share or by taking total value of shares, your answers will be same. So here 20 divided by 160 into 100. So result is same here, 12.5%. Okay, so this is the cost of equity capital KE. Well students, so this is under the model dividend yield method or model or approach, dividend yield method. So this is the formula we use in the method mentioned here. This is here calculation of cost of equity capital under dividend yield method. Well students, so next topic I will present the second topic, second method for calculating cost of equity capital. All of you watch it and like, subscribe this. All right students, thank you very